The answer is straightforward, even if it feels uncomfortable at first. Deposit the full amount honestly and let the bank handle the reporting. If a currency transaction report is required, it will be filed automatically. That report does not harm you. It does not trigger penalties by itself. It is simply part of the system doing its job. What protects you is not avoiding the report. It is being able to clearly explain where your money came from if anyone ever asks. That means keeping basic documentation, a bill of sale, a withdrawal receipt, a written record of a gift, or any other proof that shows the origin of the funds. These documents are your safety net. They turn a potentially confusing situation into a straightforward one. As we move forward, there is one more critical development you need to know, especially if you are 65 or older. Because while these laws create risks if misunderstood, there are also new financial benefits available in 2026 that many seniors are completely unaware of. And understanding those benefits could put real money back in your pocket, legally, safely, and without any risk at all. That's exactly what we're going to break down next. Now, let's shift to something equally important, but on the positive side of the financial system, because not everything in 2026 is about risk or restrictions. In fact, there is a major tax development specifically designed to benefit older Americans, and most people have no idea it even exists yet. According to recent federal updates tied to tax reforms implemented for the 2025-2028 cycle, individuals aged 65 or older may now qualify for an additional tax deduction that can significantly reduce their taxable income. This is being administered through the Internal Revenue Service and applies to seniors who meet specific income and age requirements. Here's how it works in simple terms. If you are 65 or older, you may be eligible for an additional deduction of up to $6,000 per individual or up to $12,000 for married couples where both spouses qualify. This is added on top of the existing standard deduction that seniors already receive. That means it is not replacing anything. It is stacking on top of current benefits. For many retirees, this could make a meaningful difference in how much of their income is actually taxed. And the eligibility rules are relatively straightforward. You must be 65 by the end of the tax year, and your income must fall below certain thresholds, generally around $75,000 for individuals or $150,000 for joint filers, though exact limits may vary based on filing status and adjustments. Now, why does this matter in a conversation that started with bank reporting rules and cash transactions? Because it highlights a larger truth about the financial system in 2026. It is both highly monitored and highly structured with benefits, but only if you understand how to navigate it correctly. On one hand, you have strict reporting requirements like those tied to the Bank Secrecy Act, which ensure that large cash movements are tracked for transparency and security. On the other hand, you have legitimate tax advantages designed to support seniors, especially those living on fixed incomes. The system is not designed to punish ordinary people, it is designed to track financial activity and distribute benefits. But misunderstanding either side can lead to unnecessary stress or missed opportunities. And this brings us to the most important part of everything we've discussed: what you should actually do moving forward. First, always remember that cash deposits above $10,000 will be reported automatically through a currency transaction report. That is normal. That is expected. It is not a sign of wrongdoing. Second, never attempt to structure your deposits to avoid that threshold. Even if your money is completely legal, splitting transactions to avoid reporting can create serious legal problems because it violates federal structuring rules enforced through financial monitoring systems tied to the Financial Crimes Enforcement Network. Third, if you are ever handling a large sum of cash, your safest approach is complete transparency. Deposit it openly, allow the system to generate whatever reports are required, and ensure you can explain the origin of the funds if asked. That explanation is not about suspicion, it is about documentation. A simple bill of sale, inheritance letter, or bank withdrawal record is often enough to clarify everything. Fourth, if you are a senior, you should take time right now to review whether you qualify for the new deduction benefits available in the 2025-2028 tax period. Many people miss these opportunities simply because they are not aware they exist. And in many cases, that lack of awareness translates directly into paying more taxes than necessary. The key point is simple. While one part of the financial system focuses on monitoring transactions for safety and compliance, another part is designed to provide relief and support, but only to those who actively understand and use it. Finally, the most important takeaway is this. In 2026, financial awareness is no longer optional. Banking systems are more connected than ever before. Transaction monitoring tools are more advanced than ever before. And at the same time, legitimate financial benefits are more available than many people realize. The difference between confusion and confidence comes down to one thing: understanding how the system actually works, instead of relying on assumptions or outdated information. So whether you are withdrawing cash, depositing savings, or simply managing your retirement income, the rules themselves are not your enemy. Misunderstanding them is. If you stay transparent, keep basic documentation, and avoid trying to outsmart reporting systems, you remain fully within safe and legal boundaries. And if you take the time to understand available deductions and benefits, you may actually improve your financial position significantly without taking any risk at all. In the end, the message is simple. Don't fear the system, learn it. Because in today's financial world, knowledge is not just power, it is protection. Today is April 12th, 2026, and if you are a senior living anywhere in the United States, there is something happening right now with your bank account that you need to understand before you make your next cash move. This is not fear-mongering, and it is not speculation. It is based on real federal law, specifically the Bank Secrecy Act, a law that has been in place for decades but is now being enforced with a level of precision and technological power that most people are not prepared for. And here's the reality. What you don't know about this law could put you at risk, not because you did something intentionally wrong, but because you followed what seemed like common sense. That is exactly why this matters right now, because in 2026, banks are no longer just passive institutions holding your money. They are active participants in a nationwide financial monitoring system that connects directly to agencies like the Financial Crimes Enforcement Network, often referred to as FinCEN, and yes, that information is accessible to the Internal Revenue Service as well. Now let's get straight to the rule that triggers everything: the $10,000 threshold. Under the Bank Secrecy Act, any cash transaction of $10,000 or more, whether it is a deposit, withdrawal, or exchange, must be reported by your bank to the federal government. This report is called a currency transaction report, and it is filed automatically. You don't have to request it. You don't sign anything special to trigger it. It simply happens. And here is the part that most people misunderstand. This report does not mean you are in trouble. It does not mean you are under investigation. It does not mean the government is coming after you. It is simply a record that money moved. That's it. If you sell a car for $15,000 in cash, deposit it, and your bank files the report, you have done nothing wrong. If you withdraw $12,000 from your savings to pay for a home repair, the same rule applies. Completely normal, completely legal. But where people get into serious trouble is not with the report itself. It is with how they try to avoid it. And this is where things start to become dangerous, especially for seniors who may be trying to be cautious without fully understanding how the system works. Many people believe that staying under the $10,000 limit keeps them safe or off the radar. So instead of depositing $12,000 all at once, they split it into smaller amounts, maybe $6,000 one day, $4,000 the next, or even multiple deposits across different banks. On the surface, that might seem like a harmless or even smart decision. But under federal law, that behavior has a specific name: Structuring. And structuring is not a loophole, it is a crime. It doesn't matter if your money is completely legal, fully taxed, and honestly earned. The moment you intentionally break up transactions to avoid the $10,000 reporting threshold, you are violating federal law. That is a critical point that many people simply do not realize until it is too late. What makes this even more serious in 2026 is the technology behind enforcement. Banks are no longer looking at transactions in isolation. They are using advanced AI-driven systems that analyze patterns across time, across accounts, and even across different financial institutions. That means if you deposit $9,000 at one bank and then $3,000 at another bank a few days later, those transactions can be linked. The system doesn't just see individual deposits, it sees behavior, it sees patterns. And when those patterns suggest structuring, they get flagged. Once flagged, your account activity can be reviewed, reported, and potentially escalated. This is where a simple misunderstanding can turn into something much more serious. Because from the system's perspective, intent matters, and patterns are how intent is detected. So before you make your next cash transaction, you need to pause and understand what is actually happening behind the scenes. This is not about avoiding the system, it is about working within it correctly. The law is not designed to punish honest people moving legitimate money. It is designed to detect suspicious behavior. But if you unknowingly mimic that behavior, the system does not automatically know your intentions. It only sees the pattern, and that is why awareness is your best protection. Because in today's financial environment, the difference between a routine transaction and a flagged activity often comes down to one thing: how you choose to handle your money. And as we move forward, what you are about to learn next could be the difference between staying completely safe and stepping into a situation that quickly becomes very difficult to reverse. Now that you understand the basics of the $10,000 rule, it's time to focus on the part that truly catches people off guard, the legal concept of structuring and why it is treated so seriously under U.S. law. Structuring, sometimes referred to as smurfing, is not about how much money you have. It's about how you move it. Under regulations enforced by the Internal Revenue Service and monitored through systems connected to the Financial Crimes Enforcement Network, structuring is defined as deliberately breaking up a large amount of cash into smaller transactions specifically to avoid triggering a currency transaction report. And here is the part that shocks most people. It does not matter if your money is completely legal. You could have earned it honestly, paid taxes on it, and have full documentation, but if the pattern of your deposits suggests that you intentionally tried to stay under the reporting threshold, that alone can be enough to trigger serious consequences. Let's break this down in real-world terms so there is no confusion. Imagine you have $12,000 in cash from selling a vehicle. Instead of depositing it all at once, you deposit $5,000 on Monday, $4,000 on Wednesday, and $3,000 on Friday. In your mind, you are simply being cautious, but from a regulatory standpoint, that pattern can look like an attempt to avoid reporting. Or consider another scenario. You deposit $9,500 at one bank, and then a few days later deposit $2,500 at another bank. You might think spreading it out makes it less noticeable. In reality, modern monitoring systems can connect those transactions almost instantly. These systems don't just look at single accounts, they analyze behavior across institutions, timelines, and transaction types. And when they detect patterns that resemble structuring, they generate alerts that can lead to further review. This is what makes the 2026 environment fundamentally different from even a few years ago. The technology has evolved to a point where flying under the radar is no longer a reliable concept. What happens next is where the situation can escalate quickly. Once activity is flagged, banks may file what is known as a Suspicious Activity Report, or SAR. Unlike a standard currency transaction report, which is routine and expected, a SAR signals that something about the behavior appears unusual or potentially unlawful. And here's the key difference. You are not notified when a SAR is filed. The process happens quietly, behind the scenes. From there, the information can be reviewed by federal authorities, and in some cases, it can lead to deeper investigations. This is where people find themselves in situations they never anticipated, because from their perspective, they were simply managing their own money carefully. But from the system's perspective, the pattern suggested something else entirely. Even more concerning is the possibility of asset seizure. Under certain circumstances, if authorities believe that structuring has occurred, they can move to seize the funds involved. And yes, this can happen even if the money itself is completely legitimate. That is one of the most controversial aspects of these laws, but it is also one of the most important to understand. Because once funds are seized, getting them back can be a long, complex, and stressful legal process. It often requires documentation, legal representation, and time, none of which most people are prepared for. This is why financial experts consistently emphasize a simple but critical rule: transparency is safer than avoidance. Trying to work around the system can create far more risk than simply following it. Now, let's address another major misconception. Many people believe that staying under $10,000 repeatedly is perfectly fine as long as each individual transaction is below the threshold. That is not how the law works. The law is not just about individual transactions, it is about intent and pattern. If your behavior suggests that you are intentionally structuring deposits to avoid reporting, then the total pattern is what matters, not the individual amounts. This is why even a series of smaller deposits, $2,000 here, $3,000 there, $4,000 somewhere else, can still raise red flags if they appear coordinated. And with the level of data analysis now in place, these patterns are easier to detect than ever before. So what should you actually do if you are handling a large amount of cash?